We are live. Episode 23, the Capital Spotlight podcast. Cheers to that. We are coming to you incredibly casual because it's a Saturday. And you're
That's
in the
right.
office. I'm in the home office. Believe it or not, it's gloomier here in Phoenix, Arizona than it is in New York City. Very rare for that. We've got a very loaded show here in the 23rd edition of the Capital Spotlight podcast. As always, your host, Craig McGrother, the Director of Business Development at Lone Star Capital, with the co-founder and principal, Rob Beardsley himself. How are you today?
I'm doing excellent. It's a beautiful Saturday. I just got done working out and I'm going to go play some pickleball later. So it's a nice active Saturday.
It really must have been such a good day to leave me delayed 30 minutes, but I guess when you're the boss, you can delay anyone. It's okay. It's okay.
I
I won't hold it
do
against you
take
too much.
punctuality very seriously. So I do apologize for showing up late to this recording session.
Right. Well, I will hold it against you, but it's okay. I'm sure you'll find a way to make it up for me. On to the agenda for the show. We're going to talk about growth conversations, as it's going to be very interesting coming up. Deals are starting to get juicy. And if you're saying yes to something, you're saying no to something else. So we're going to talk about that. We're talking about Meridian and their issues currently with Freddie. We're going to talk about Arbor and that article that just came out. Treasury talk, institutional equity, LTV preferences, positive leverage, what deals institutional equity will not do, watch talk, and cloth talk. But first, a little housekeeping. We are having our webinar on November
30th.
30th at 2 p.m. Eastern. I believe this will come out that week, so please watch that. I hope you had a great holiday season and Thanksgiving was awesome. Hopefully you got to be with your family or got to take a little time off and were away for a bit. Obviously, family is very important, so we hope you and yours had a great time together. But yeah, and then additionally, if you are looking to raise equity, if you are a capital partner, if you're looking to learn more about Lone Star Capital and how to work with us, please reach out to me. My email is craig@lscre.com. Once again, craig@lscre.com. Once again, if you're a fund manager looking to bring equity to the best deals in Texas, let me know. Okay. With that said, let's get into it. Growth conversations. So we are very excitingly getting impeccable deals that are coming our way. Impeccable. So much so that we might just have to mess around and tie up a couple deals. But if we tie up a couple deals, that means we're going to be bandwidth constrained. So what does that mean? That means we got to be very selective with what deals we want to tie up. There's so many tiers to this, right? A $10 million deal and a $100 million deal, which, yes, we've done both. A $10 million deal and a $100 million deal from a marketing and packaging perspective is on Brad's end and likely on your end close to the same amount of work. Would you say that's true?
Yeah, it's a few more conversations, but yeah, it is not a dramatic difference. So I know where you're getting. You're getting to a very salient point.
Yes. So the equity, naturally, you're going to have to raise probably 4 times more. But from an organization and from that perspective, it's very inefficient to do a $10 million deal compared to a $100 million deal. So we coming up here have to decide what we want to say yes to. If all deals are looking so good, on your perspective, how do we kind of decide what is best? Is it based upon the grade of the asset? Is it looking at the risk-adjusted return profile? Is it looking at what might be easiest to raise? What our capital partners want to do? How do you kind of dissect and analyze, opportunities like that we're seeing right now?
Well, in a normal market, we would mostly be focused on the risk-adjusted return, and that's how we would determine what deal we would do. Is we would crunch the numbers as deals come in, and if the deal is attractive from a number standpoint, we would pursue it. And the way that that would work is the vast majority of deals would certainly just not work. We would come in with a bid, and we would get outbid because the market was competitive. In today's environment, and it's only going to get increasingly more so this way in 2024, the market's dislocated. Prices have come down and projected returns are higher across the board. And so you get a little bit spoiled for choice in this environment. And this is new for us, right? We haven't been through a cycle like this where you can go in and buy at really attractive bases and get really good deals due to the market dislocation. So The way we're approaching it is different than a normal market, because now all of a sudden you're underwriting deals and you've got a handful hitting your desk that makes sense. And you could reasonably acquire any of them. And the numbers look good. It'd probably be a good deal. So now how do you differentiate? We've talked about this on the show before. There's now X factors outside of the numbers that need to be considered and weighted more heavily, because if you just say yes to all the deals that look good by the numbers, you're going to buy everything, right? If everything looks good, how
I'd
do
be
you
fine with buying
differentiate?
everything right now. I'd be
Well,
fine with it.
you would be fine, but then you'd be complaining about how busy you are, right? So it's a fine balance of being busy, productive, but not overwhelmed. So we have to turn good deals away, frankly.
So a good deal in this environment is changing, right? Because now we're seeing deals with, call it 1990s or newer, which is like a core plus property in most respects, even maybe some early thousands deals, late 90s deals that are getting and achieving just based upon cap rates here and what we think the exits will be with the exit cap. We're seeing almost close to 15 to 17% IRRs on deals with basically very light value add, which is before in 2023 was what a good deal would look like with leverage points and whatnot. So we're really seeing different dynamics coming up. So, the definition of a good deal is changing right now. And we have to ask ourselves the question, okay, what do we actually want to own? What do we want to buy? How do we angle this? And what is going to be, frankly, I hate to say this, but kind of the path of least resistance in reference to raising the money for the deal, right? Because
Right.
why make our lives more difficult in an already a challenging environment, right? And also it's like, well, is this an opportunity to buy really sweet and sexy looking real estate that we're going to want to hold and want to do business with? And, if we have to hold it for 7 years, maybe we'll crystallize the opportunity, and we can talk about promote crystallization at some point. But is that something we may want to think about? What's your take on this matter?
Well, I like what you said about basically it's kind of a buzzword, buying core plus real estate, but getting value add returns. That's a very good risk adjusted return. And that's what we're seeing in today's market. The other direction you could go in is you could say, well, how about I buy value add real estate and I take the risk, but now I don't get value add returns. I get deep value add returns, or I get opportunistic returns. So it's a question of what space do you want to play in? What makes the most sense? And for us today, what makes the most sense, and we've been beating this drum for a long time, is buying deals with solid in place cap rate. That is number one, most important, because that determines the attractiveness of our financing. Because today, by and large, we're still not seeing opportunities where it makes sense to do a bridge loan, right? We're not compensated from a return standpoint for the increased cost and risk of a bridge loan today. So right now, whether it's a core plus deal or even a value add deal, it still needs to have enough in-place income such that we can finance with medium to long-term debt with Freddie Mac or Fannie Mae. That's just the best strategy to go about buying a deal today. I do think that's going to change though. So today, I think the best deal, the picture perfect deal, would be a deal where you're buying a nice newer vintage asset that you don't mind holding long term. It's not a headache to manage. And I do believe we're going to go into a recession next year. So in a recession, if you have worse tenants that make less money, you're going to deal with more evictions, you're going to deal with more delinquency, more wear and tear on the property. And so if you buy a nicer, newer asset, you're going to have less of those problems. So
Yeah,
today,
I
if you
think
can,
we were looking at a deal, if I'm not mistaken, that his income's around 70K with probably a nice average median, home sales. So that's a little bit more of a sturdy tenant base, to your point, as opposed to, hey, C plus, B minus, 36K incomes, where it might be a little bit more of a fluctuation situation with their kind of working ability, right? So to that point, what are the key points in, I guess you could say yardy metrics that really make you stand out, make you feel comfortable for, kind of a sturdy more recession proof, multifamily opportunity?
yeah, median household income is number one. That's going to determine mostly what your demographic is going to look like and how you're going to what level of difficulty the property is going to be to manage in a recession. So yeah, so just to finish that thought, if you buy strong in place cap today, and if we do have a recession next year and it's a tougher year or two, the newer asset, the nicer asset where there's higher median household incomes is going to do better. However, when we go in that recession in 2024, then I think you'll still be fine buying those newer properties. You'll still do well. But where I think you'll get outsized returns is when you now start to go dumpster diving in 2024. I still think it's too early today, but in 2024, there's going to be opportunities to buy deals that are distressed. There's going to be not just financial distress, but physical distress. And one can lead to the other. So I want to break that down a little bit because right now, what we're seeing in the market is by and large only financial distress. What that means is you own a property, the property is performing fine, occupancy is strong, collections are strong, but you have a floating rate loan that went from 3.5% to 9%, right? And that's causing financial distress on the property because while the property has a strong NOI, it's getting eaten up and more via debt service. And so you have negative cash flow, and that's financial distress. And on the other hand, physical distress has nothing to do with your balance sheet. It has nothing to do with debt or interest rates. It has to do with what's going on actually at the property level. So physical distress could be deferred maintenance. It could be low occupancy. It could be tenants aren't paying rent. It could be crime, right? That's physical distress. And like I said, one can lead to the other, right? If you have enough physical distress, occupancy is low for long enough, that's going to make it hard for you to service your debt, which can then put pressure on your property or cause you to be in default, which is now financial distress. The other way around, you could have financial distress where you have negative cash flows for so long that it could cause physical distress. Because if you are struggling with negative cash flows, you're going to now not invest potentially, not invest into the property. You're going to not maintain it to the best of your ability because instead you're going to be stealing that cash effectively to pay your lender. And that's going to eventually lead to deferred maintenance and physical distress. So like I said, one leads to the other. Right
I mean,
now we have
I know I've heard of groups right now that are taking money from the OpCo or their reserves and are throwing it into making debt payments, which is scary because if you're having those issues right now, I don't foresee us getting out of this issue coming up. And let's say if rents soften, then you're really just burning cash, right? Or if occupancy goes down in addition to that. So very, very concerning to your point, and it's just buying at the right times. And then there's also a lot of groups too that the management at the property level, because there's management, upper management, then it flows down to regionals, then, people at the specific property, right? And if they get kind of catching wind that the ship's not doing well, everything can kind of start collapsing, which is its own set of issues. And then you've got really big problems because if they stop caring, then it's just, imagine what happens to everything else. And we're experiencing that for sure, not on our end, but on the acquisition end, which is very exciting.
That's a really good point. That's another way that financial
And it's
distress,
and that is curable.
that's another way that financial distress can lead to physical, where if the corporate entity is struggling financially and there's rumor problems and things like that, like you said, the on-site teams and the managers on the day-to-day, they could feel insecure about their job, about their future prospects, and they could not care about the property anymore because they think the property is going to get fire sold or they think the property is going to get foreclosed on.
Or maybe they're going to get fired because, hey, guess what? Here, and we can actually, this is a very good conversation. We haven't talked about this, but we haven't talked about this yet. But think about this. Hey, property here, and they think that it's going to get sold or they think the property is going to get foreclosed on. Well, why should I care about the property? I'm basically going to quiet quit while I'm here, right? And if this property is going to sell, that's a lot of times why a lot of groups don't want to talk about that or acknowledge it to their staffing because they don't want them to, be basically freshening up the resume instead of actually taking care of the needs and issues at the property. And then next thing you know, oh, if I'm going to get fired, why do I care right now? I'll just collect my paycheck and do nothing all day, right? So that can start happening very quickly. And a lot of times, that's why when we're selling our properties, really want to keep it quiet, and why many sellers do not want to talk about that process while they are running their operations. Because what if the sale doesn't go through? And next thing you know, and it's not as if it's what if the sale doesn't go through, but also these sales don't happen overnight. They're 2 to 3 and maybe 6 month long processes.
Yep. Totally. So we've experienced that. We've seen that on the buy side where someone's tried to sell a property, falls out of contract, operations deteriorate, and then that they end up selling for a lower price. And that's one of the reasons why sellers want certainty of closing, and they're willing to, not always, but sometimes, not take the highest bidder and instead pick the bidder who's coming in with the highest certainty of closing. So speaking of which, I would love nothing more than to receive a phone call on this podcast, because I'm waiting for a very special call today from a seller. We're hoping to get awarded a deal in Houston, and it's an interesting bidding process where there's a broker involved, but we're bidding actually directly. We're sending the bid directly to the seller, and the seller is supposed to pick. It's a Saturday, but the seller wants to pick a buyer today. So I'm really hoping to get that call, and I'd actually love to take it on speaker on this podcast, but that's wishful.
As the very, very successful producer in the music industry, DJ Khaled would say, another one. And if you're looking to raise equity for deals, we've got multiple opportunities for you coming up here. So please reach out to me if you're a fund manager, co-GP, JV, check writer, whatever it may be. Message me, call me. You have my information. But once again, it's Craig@lscre.com.
Excellent. So let's finish this point up with, we've explained the financial and physical distress element. Right now, the economy remains strong. I do think it's going to weaken, and that's going to contribute in its own right to physical distress. But right now, the economy is strong. So by and large, what we're seeing is, due to the rise in interest rates, we're seeing financial distress. And like I said, that financial distress will lead to physical distress in certain cases. So next year, when we see the economy soften and financial distress finally lead to physical distress, you're going to see deals that are going to be suffering from high vacancy, bad collections, increase in crime, and piled up deferred maintenance. And those deals they're going to be sold for a song. They're going to get so cheap, and the seller's going to be forced to sell. And it's actually worse than that, because those deals, if they're not already, they're going to be worth less than the loan amount. So the lender's actually going to have to get involved, either by way of taking a discount on their taking a discounted payoff in order for the sale to go through, which we're already looking at some of those opportunities now, or the lender's going to have to first foreclose and then sell the property at a loss. So that's the resetting of the basis that is going to occur, especially on these more distressed opportunities. And that's where we're going to see the opportunity to borrow bridge debt, because those deals are barely financeable, right? Fannie and Freddie won't touch them. You can't get long-term debt on them. So you're going to have to actually go to a bridge lender in order to buy something that is 70% occupied, has a lot of deferred maintenance. You're going to have to clean everything up, but there's going to be enough upside, because those are going to be 25 IRRs, 35 IRRs.
So when there's situations like where it's bridge, if there actually is truly a shop that offers bridge and equity, would you ever consider wanting to work with a JV partner that can provide both sides of that because they're comfortable? Because then a flagship does that, right? Would that be something we would want to do, or would we at least give them a look from a bridge perspective? Is it sometimes easier from a sponsor level to make a maneuver like that, to keep everything in house there, to be a good partner in that sense?
I don't think so. I mean, so first of all, 9 times out of 10, a group is not going to be willing to do the debt and the equity on the same deal, right? It's self-dealing. So they can't put their debt fund can't do the debt, and then their equity fund can't do the equity. It doesn't work. So that's not an option. But then also, those types of groups usually have a higher cost of capital than groups that are set up as true bridge lenders, debt fund type executions. And as much as we're seeing bad publicity about CLOs and CLO lenders, that's the cheapest cost of capital. And if you have the right partner and a good CLO lender, I still see it making sense to work with a bridge lender like that over a balance sheet lender. Balance sheet lenders, they like to, and I don't want to say this disparagingly, but they like to brag about the fact that they make the loan themselves, they service it themselves, they keep it on their balance sheet, they're a good partner, they're better with the construction draws. That is all true, but it comes at a 100 to 200 basis point increase in rate, and that's not usually worth it.
So to tie this growth conversation up with a bow, how many deals do we want to have at once? What's our bandwidth capacity? What's the turnover of these? And In a perfect world, how are we juggling everything?
I think one strategic tool to help juggle bandwidth and a pipeline is packaging deals up. So if you're pursuing, let's just say we're looking at 2 deals in Houston right now that we'd like to put under contract, but we already have a San Antonio deal under contract. So how do we juggle that? Do we want to have 3 separate offerings right now? Perhaps. Or what we could do is we could take those 2 Houston deals and we could package them together. And now we have a Houston 2-pack, and we go out to investors and we raise money with those deals being
Bundled. Yeah.
bundled together, and you cross the promote and you raise money that way. So it's one entity there and then the San Antonio deal. And so now you're effectively managing 2 raises at once. So I feel very comfortable in our ability to do 2 raises at once, but that's technically 3 properties. Would I be comfortable with us doing 3 raises at once? Maybe. I think now's the
Well,
time
and
to
it
get
becomes
ambitious.
challenging. And well, here's the thing that becomes challenging on my end, right? So I have opinions. I have strong opinions. But I try to be as objective as possible with everything we do. And I try to get very objective with regards to, what deals we're raising for. And I just try to call it down the fairway, down the middle. I like to call balls and strikes and kind of point out the pros and cons of each property. But when you have 3 properties that you're raising for and you're talking to retail equity or capital raising partners that you have a relationship with, it's going to be very hard to say, well, Craig, which property do you like the most? It's like, well, maybe I like the Dallas deal more than the San Antonio deal or the Houston deal. Or maybe it's like, honestly, I wouldn't touch the Dallas deal with a 10-foot pole because X, Y, and Z, and I know this. But how do I, on my end, and on our side, how do we instill confidence? And the answer is it's just going to be different, and it's gonna depend on the per property basis. But it's going to be very interesting to kind of cross sell and try to be objective on these when we do have options and multiple of them at the same time, and we have multiple tranches to raise for. It will be challenging. It will be tough. So it'll be very interesting to see what will occur over the next year as far as opportunities coming up and differences. And also, it's interesting too because if we had 2 Houston deals that we're raising for that are different, let's say it's a market rate Houston deal and an affordable, structured deal in Houston. Well, then that's 2 different profiles, right? But how do you handicap it when you've got 3 different markets we're playing in? Because we may have deals under contract in 3 different markets coming up. We may have a Houston deal. If we get a great phone call on this conversation, we may get a Houston deal. We may or may not have a Dallas deal currently, and we may or may not have a San Antonio deal here currently. So if we have those opportunities and we have 3 at once, that makes it a little bit easier because it's geographically different and these are all different structures. But handicapping these and kind of talking, as trying to make it as apples to apples as possible when it's apples to oranges because it's a different market will be challenging. And I got to get really smart really quickly on that. And I have to be careful about not saying anything negative about any of our properties or, kind of steering people in the right direction because people do trust and take my opinion seriously and yours as well. So it'll be very interesting to see how we will navigate that when we have a lot of options coming up. And a lot of the reasons why I have a lot of options coming up is because which is our next conversation, which is where treasuries are at right now and where cap rates are going. So treasury talk. Treasuries have been wildly volatile and cap rates are finally starting to expand. So early in this year, like a 5 cap in Dallas or a 5 cap in San Antonio. I mean, well, I can't speak to San Antonio as much because it's a little bit newer. So I don't want to speak to that. But Houston and Dallas, a 5 cap was kind of market. Now it's expanding a lot. So caps now for deals that we're doing are kind of mid sixes, but treasuries at about 4.4, which they were today for the 7-year. That's coming to the point of positive or neutral leverage, which is very exciting. So meaning for the first time in a bit of time now, we actually can get positive neutral leverage, which means LTV and LTC can be a little bit more high. So what's your kind of take on everything with the Treasury? Naturally, the market is ripping right now. Do you think the market is ripping because we think we're close to the stock market, that is? Do we think that it's because we think that people are pricing in the fact that maybe rates will stabilize and or maybe there'll be a slight hike or a slight cut coming up, or at least there's stability? I think if anyone looks at real estate trends and graphics and charting, once rates go like this, transaction volume gets very stagnant, if not non-existent. Once it's like this, though, after like this, it starts to happen again. And when it starts getting cut, the market gets hot. So do we think that the market is pricing in and is ripping and things look good because we're not going to see any more increases? What is your take on the matter? Pull out your crystal ball.
Yeah, the market started reacting very positively to because it believed because of the CPI print that came out a couple weeks ago that we are not going to see any more rate hikes. And so basically the percentage probability of a rate hike has gone to almost zero and actually cuts. It's more likely that we get a cut than a hike coming up in Q1 even. So that the market interpreted that very positively, and I think too far. So the market thinks that we're going to have a soft landing and everything's going to be great. And that's why the stock market is making highs. I think this is not true. And I think we're not going to have a soft landing. I think we will have a recession. I think we're going to see earnings not perform well. And I think risk premiums are going to widen. So what that means is this essentially, I think the stock market's going to go down. I think now would be a great time to sell stocks. I don't believe in this rally whatsoever. Going back to your point about treasuries have come down about almost 20 bips. I mean, I don't know. This will obviously be wrong because this will be published later, but treasuries seemingly are on the way down, which is fantastic for us because our debt is priced off of treasuries. And so we're able to finance for cheaper based on a lower treasury, which helps our ability to achieve positive leverage, which positive leverage has been kind of the word of the year because when you're talking to investors, all they want to know is, does the deal have positive leverage? They want to invest in deals where you're buying for a 6.5 cap and your debt is at 6%. And then voila, you've got positive leverage. That's what they want.
And that means you can, typically speaking, put less down. It's when there's debt is really high and cap rates are low is when you have to put, way more down, often north of 50% of, equity down for the deal. Meaning if it's a $20 million deal, you've got to raise north of $10 million to make the numbers pencil.
Right. So due to DSCR constraints, you have lower LTVs when rates are higher versus cap rates. And then when the opposite is true, when there is positive leverage, you can actually qualify for more debt because there's enough income to service that debt. So you can actually max out at 75 or 80% LTV, which is great. And that brings us to a future topic, which we'll talk about, which is, what is the right LTV and what do investors want from an LTV? But focusing on treasuries because treasuries have made a very big move recently, and they've been making very big moves up and down over the last year. So with such volatility, it's very difficult to transact. That's what the market hates the most is volatility. If the market is stable and predictable, people can come together and make deals. But when treasuries are so volatile, it's hard for buyers and sellers to connect because how do you have the confidence to put a deal under contract when treasuries might go up 50 basis points, 100 basis points
While you're in escrow?
Exactly. So
Sounds like someone we've talked about and
we've been through that and we've been
Yep.
burned by that. So we know all about it. And so unfortunately, that volatility has to get priced into the asset, which means you have to reduce the price. The value of an asset goes down with the higher volatility because a buyer has to go, well, shoot, treasuries are 450 today, but what if they go to 5? Well, let me just bake that contingency into my numbers so I'm safe. And then that results in a lower offer price to the seller. So the seller effectively, not always, but basically someone has to eat this volatility. We ate the volatility because we put a deal under contract and then rates went up 7,500 bips and we had to walk away from the deposit and we lost almost $1 million. Very painful. The other way to go is the seller could eat that volatility by accepting a lower price. And so that if that rate rise does materialize, the buyer has hedged for it in their numbers. So volatility it makes it tough, but it also creates opportunity because guess what? Volatility goes both ways, up and down. And so right now we're seeing volatility to the down, and we could very well find ourselves in a situation where we put a deal under contract when treasuries are, let's just say 450. And what if treasuries go down to 425 or 4? That's going to make that deal look really, really attractive. So that's what we're seeing on the volatility side. I think treasuries will continue to be volatile for at least another year or so. But I think the general direction of short and long-term rates is lower.
Well, it's exciting right now because caps have finally expanded, and that means deals will start to make sense. And cap rate compressions where lots of millions of dollars are created. So it is nice to see that the dam in that regard is slightly breaking, if not has gone, and that's why we're seeing a big uptick in deals that we like to do. And it's really nice because I feel like the hot girl at the party right now, in many respects. We just closed the $100 million deal. Therefore, it's funny. I don't know why that happens. It happened to
That's
be on someone else's show too, but whatever. This is bad radio. Thumbs up came up on the Zoom, but we closed a $100 million deal. That didn't go again. And two things. Equity is impressed. I think there's probably some groups we shot that too, saying there's just no way that there's just no way in which they would pull that deal off. So maybe on the first $100 million deal, I'm just gonna let them do it. And if they do it, good for them. And I will work for them the next opportunity. Now they're more interested in us because pulling something off like that is not easy to do. And then secondly, every broker and sponsor is looking at their deals if they have a situation saying, oh my God, we got to get away from this. And Lone Star is a very viable contender to actually close with certainty. So it's really cool that this is all happening in real time and together. So much momentum for us. On to another conversation, which I've found very interesting, and or a thought that's been very interesting that I want to have a conversation with is too much leverage and what institutional equity wants to see from an LTV and LTC perspective. So we've gotten some feedback recently on some stuff that we're working on that our leverage is too high. But the reason why it's too high, it's due to a nice affordable structure associated with the deal, plus about 100 plus bips of positive leverage on the deal, meaning when that happens, there's a big cushion for the DSCR. So, that is well north of 1.25 in year one, even with basically max proceeds and leverage from the lender, which is crazy. So I never thought we'd see this because leverage was so bad these last couple of years due to where cap rates were and where treasuries were at and interest rates, right? So now that it's changing in real time, it's funny to see that the whiplash effect is no, we can't get our people to feel comfortable with that leverage point, and we're open-minded to raising a couple extra $1 million for a deal if it makes our partner feel good about it. But it is interesting to see the other kind of side of it, because before, if you were an investor, leverage makes great returns. Unlevered returns and levered returns are two different ball games. Naturally, we're in the leverage and debt business, being in real estate. So we're seeing that all in real time, but would love to know your kind of comments and thoughts about the institutional equity responding to not wanting to be north of 75% LTV.
Yeah, I think it's fair that we're getting pushback on leverage being too high. And so just so people understand, we have a deal under contract that we are projecting to use 80% leverage just because the agency debt sizes to 80% LTV, and that is approximately 75% LTC. However, like you mentioned, the reason that we feel comfortable at that higher leverage point is actually because we are getting a partial tax exemption, which means that the NOI is much higher and the cap rate's much higher. And if you were to bake in the increase in value due to the tax exemption, the true LTV is actually more like 65%. So on paper, the LTV looks high at 80, but it really is about a 60% LTV. But that's something that is hard to explain and not everyone can get comfortable with. And also, comfortable or not, many private equity firms just have a limit in their fund that says, nope, you cannot do leverage more than 70. Nope, you cannot do leverage more than 75. So no matter what, there can be constraints like that. But usually the language is more flexible where they can get comfortable if there's a story there, which in this particular case, we do believe we have a story. But generally speaking, private equity firms are not going to be as comfortable doing high leverage as retail investors are, which is perfectly understandable. However, it's funny because we humans are always biased by recent experience. So recent experience in 2020, 21, 22 has shown us that, hey, taking on high leverage is bad. Look at all the bad things that are happening because of it now. But in today's environment, we're in a very different environment, and actually taking leverage when the deal really makes sense it looks good and it makes sense. And I think actually it pays to take more leverage today. Yes, back in 21, you should have been doing deals at lower leverage. but likely you were doing deals at higher leverage because that's just the nature of the market. But then today, when prospective returns are high and cap rates are high and there's positive leverage, it actually makes sense to take on 80% leverage if that's something that you're comfortable with. So I think it's just we're battling a little bit with recency bias, but that's just the nature of humans, right? We have emotions.
So what do you think is the ideal leverage point for them, for institutional people? And then for retail, do they just not even think about it? Because seemingly we both learned more recently that a lot of more retail and maybe not as seasoned capital raising partners don't really know how to read deals, actually.
Yeah, retail investors are most of them are unfortunately less sophisticated, and also they're more willing to take risk because they are more attracted to headline return numbers than they are as far to risk and risk adjusted returns. It takes a more savvy investor to recognize the concept that, you know what, for a little bit less leverage and a whole lot less risk, I'm okay with a 12. That's a rare person. It's a sophisticated kind of family office, long-term thinking type person. Because most investors go, 12, that sounds boring. The sponsor down the street's offering me 18. That sounds fun. Let's do that. Right. So the retail investor thinks more so that way typically. And I mean, as long as the deal makes sense on a risk adjusted basis at 18, go do the 18. That's great. What doesn't make sense is doing a deal at 18 and the risk adjusted return is not there. If you're taking a ton of risk and that 18 is not a true 18, that's a false front, right? And you want to be careful of that. So it goes back to sound fundamental underwriting and making sure that the deal structure matches the business plan and matches the objectives of the investors. So you ask what the ideal leverage point is for private equity firms. I mean, you know better than me because you're talking to them every day and you're getting the feedback. It sounds like 75% is a sweet spot, but I also think it's a nuanced conversation where you have to explain the deal, the story, what the CapEx plan is, and kind of what the stabilized returns are and what the stabilized LTV is as well.
Do they, when I say they, does institutional equity, I should say to be more specific, do they struggle with basically who they need to respond to from a leverage point, or is it just they refuse institutional equity refuses to get wiped out by having a deal too thin and not having enough buffer for their cushion in reference to just reserves in a potentially changing environment?
I think it's mostly about what they're comfortable selling to their investment committee, right? They don't want to just as we want to have easy lives and sleep well at night, they want to have easy lives. Why do they want to make things harder for themselves? Why should they take the deal that has high leverage and then they have to go explain to the investment committee that the property is getting this complex tax exemption and no, really the LTV is actually here and they have to do all this extra work when they could just go do a different deal or that same deal at lower leverage and just say, here you go, investment committee. I'm giving you what you want. You wanted a 75% LTV loan. Here's 75. So I think that is the main driver. And I'm not saying that that's a bad policy by the investment committee. I'm just saying that the acquisition people that are doing due diligence, they're driven by their investment committee. I mean, I do think that it does make sense by and large to do modest leverage and not high leverage because the incremental return is often not worth the additional risk.
Got it. Okay. Any other thoughts you want to wrap up with regards to, institutional equity, LTV preferences, or maybe our preference as we move forward? Because naturally leverage in our world, and right now it's a good time to take leverage, is, going to obviously enhance returns. So can you kind of speak to our philosophy right now? Are you just going to max it out? What is your take?
Yeah, my philosophy is you should use the debt that complements the deal itself and the business plan and the strategy of what you want. So everything should be in alignment. If you have a short-term business plan and a short-term strategy, meaning if you're an investor that likes to buy and sell quickly, then you shouldn't be taking on 10-year debt. That's not in alignment with your investment strategy. If you're a conservative investor that has a focus on cash flow and has a long-term outlook, you should do 10-year fixed rate debt because You are solving for cash flow and long-term investment. If you don't care about cash flow and you like flexibility, you should float, right? So all these factors should come together and they should all be in alignment. Your strategy, your business plan, and your leverage. So if you have a class A deal that you're buying for yield, you shouldn't over lever it because you don't have a big value add plan to stabilize to a higher value. If you're buying a distressed property at depressed prices and your plan is to double the property's value, then you can go ahead and take on more leverage because you're going to stabilize to a more acceptable LTV. And it all comes down to your exit test. And the exit test is your ability to refinance out of the debt that you propose putting on the property. So it really comes down to when that loan matures, am I in a conservative, safe position to take out that loan? That's what it all comes down to.
So my question is, and my only pushback is going to be from their side, and going to spin it to you in real time, is occupancy. So let's say if a deal is 90% occupied, which would pass the Freddie test, right? It's got to be north of 85% for agency, if I'm not mistaken. So we need to be there for that. What if we get a deal currently, but occupancy is a slight issue or problem, and that's the pushback, right? Is raising extra couple $1,000,000 within a reasonable request. How are we going to kind of capitalize that and make sure that we're not too razor thin to, have problems where we need to do kind of a raise reserves, not a, kind of capital call, but a reserve call, if you will. But I guess it technically would be the same thing. But, do you think it's something that we would consider doing, just raising maybe a couple extra $1,000,000, depending upon where the deal's located, depending upon, I guess, profile?
So are you saying a property has occupancy problems, therefore you finance on bridge, or you or you're still able to finance with agency, but you think the occupancy might drop after closing?
I'm saying, yeah, well, because coming up, if we close something right now, as we mentioned before, the economic environment's not bad yet. It's starting to probably get there, but let's say if jobs start to get lost. Now, I do think we're in Texas in these markets for a reason, because job growth is strong and occupations are strong. Unemployment's lower here than the national average, right? But I'm saying inevitably during a recession, people lose jobs, right? So what if we get, a delta where, or a scenario in which, occupancy goes down, right? And we're too close. Do we look at maybe break even occupancy? And then also, what if rents go down and occupation goes down? Like, let's say rents dip 10% and occupation goes down 5%. That's a very large delta. Do we, kind of on our end, back end, put some math in place to kind of correct that? Or is that too hypothetical and, I guess not positive? I'm not optimistic enough.
It's tricky. You need to balance optimism with downside protection. And so, yeah, you make a very good point. And actually, Brad and I were talking about this last night. So what we have is we have reserves that we raise up front. So we're already doing that. So the deals that we're doing, it just depends on the deal size, but we're raising approximately and usually 3 months worth of operating expenses and debt service. So we're already taking into account how much debt load is being put on the property, and we're increasing, or we're accounting for that with our reserve amount. So we might have $1 million reserve there, and that can be helpful in the next couple of years if performance lags our pro forma because of economic headwinds. So like you said, occupancy could decline, collections could decline, rents could go down, and you want to still be able to cover your debt service, right? The other thing we have is some conservative below the line additional expenses, where we basically add on more expenses to the property than we think is actually going to be needed. And that is already factored in to our analysis. So hopefully we're, as we like to do, under promising and over delivering. So that's how we account for that. And we're actually, the conversation that Brad and I were having yesterday was basically an implementation of an adjustment to that policy, of that underwriting policy, because when the market was hot, and not just the capital markets, but also the fundamentals were hot, rents were growing like crazy and everything was strong, we actually removed those extra expenses and things like that because we actually thought that performance was going to outperform our pro forma. but we didn't want to actually bake that into the pro forma explicitly because that's aggressive. We didn't want to
Well,
say,
so yeah,
oh, we think,
if that's happening, it's gonna be hard to buy deals.
yes, exactly. And we think rent growth is going to be 5% per year. Well, we're not going to put in 5% per year rent growth, right? That's just too aggressive. So now we're shifting into a new environment where we think actually, hey, instead of performance outperforming pro forma, we think that it might actually lag pro forma for a couple of years while we're in a recession. But then on the other side of that recession is going to be very good performance because of no new supply. And there's just going to be that big rebound effect, in my opinion. So yeah, we're in a very good position, and I think we do a good job of accounting for the nuances of risk, leverage, and things like that.
On to something that's not very fun. Meridian and Freddie Mac deals. So this was an article that was published. Maybe do you want to pull it up? You got really excited about this topic, which always gets me excited. So why don't you unpack this? The floor
Yeah,
is yours.
I'm sure many people in the industry have heard the news and people have been talking about it. I think they're making it in the long run too big of a deal, but in the short run, it's definitely a big deal. So basically, Freddie Mac, which Fannie Mae and Freddie Mac are uh, government-sponsored enterprises that provide a ton of debt capital to multifamily, and they uniquely lend to multifamily. So office, retail, hospitality, they don't have access to these loans, which is a huge advantage for multifamily. And in times of difficulty and dislocation like today, they're really a shining light because they're one of the few places for liquidity in the real estate market right now. So Freddie Mac's a major player. You definitely want to be on their good side. And Freddie Mac recently came out and basically blacklisted Meridian Capital. They said any deal that comes from Meridian is blocked. And Meridian is one of the largest debt brokers in the country. So what Meridian's business is borrowers like us go to Meridian and say, hey, we'd like to get a loan, please. And then Meridian goes to a seller servicer, and then that seller servicer originates a Freddie Mac loan. That's all blown up because if a loan is touched by Meridian and gets submitted into Freddie, dead. I talked to a lender last night, and they're not associated with Meridian at all. But because the loan was initially submitted by Freddie, this new lender that has nothing to do with Meridian can't even touch the deal. Freddie's blocking
So it's
everything.
basically everything that they did on the front end or now on new. So basically front end meaning, hey, the debt was given to acquire the deal. Those deals are being blocked now.
I don't know about if it's already acquired, but if it was submitted and not closed on, so if they're trying to get a loan right now, Meridian, Freddie's just blocking all that. So basically, and the reason for this is basically fraud allegations. They are saying that Meridian got too aggressive with their pro formas and the financials that they were submitting in, and getting too aggressive there. So while I'm sure there's truth to that, I'm sure that, and while I'm sure there's truth to that, I'm also sure that Meridian's not the only one. And I'm also sure that this is not a recent occurrence. This is always happening. And Freddie's only doing something now because we're in a real estate recession and there's financial distress. When the market's hot, everyone's sins are washed away and everything is fine. When the market is in trouble, now all of a sudden you're going to see scandals come out and lawsuits come out. And so we're going to see sponsors get sued. We're going to see lenders get sued. We're going to see brokers get sued. So this is one of these instances, and this is perhaps one of the first of more things to come. And so now we're hearing rumors like, okay, well, Fannie Mae and Freddie aren't going to do brokered business anymore, which I don't agree. I think, sure, in the short run, there's going to be some problems, but I think in the long run, this will be forgotten essentially, and business will go back to business as usual. So it's an interesting situation, and I think it's just reflective of the times we're in, and you're just not gonna be able to get away with things that you were perhaps getting away with in the past. So for us, it means that we're being extra careful and being very just really careful with the relationships that we have And especially with Fannie and Freddie, you don't want to get on Fannie or Freddie's bad side. And you want to make sure that you don't do anything that could potentially scare them off. I kind of think that Fannie and Freddie are kind of like they're deer, and any little wrong move can get them scared and run off, right? And so you don't want to piss them off. You don't want to do anything that could look a little funky. And that's consistency is really important. So as we're doing deals and we're submitting different deals to them, we want to make sure that our numbers look consistent, that our structure and org chart, everything is just smooth and consistent. So we're really dotting our I's and crossing our T's.
Do you think this is the first of other kind of institutions like this getting in trouble and maybe other fraud kind of getting exposed? Because when the market's so hot, people try to push the envelope. And as you mentioned, in any business, when the market's going great and returns are there, no one's getting in trouble, right? But when things get different, people get weird and things get kind of, it seems as if, items get, kind of dug into a bit more, right? So do you kind of foresee this being a stem to other issues as well? Maybe other partners or players, maybe sponsors, lenders that have kind of done potentially slightly nefarious things that haven't been called out to yet. It's funny, a Ponzi scheme or any financial fraud like that hardly gets, stopped or recognized when the market's going great because no one's really looking at it and, it's believable. But like, FTX, when, the Bitcoin or cryptocurrency market got weird, that's when that all kind of came out. When, rates are running up high and there's distress, all these other things kind of start coming out. So do you think this will be a chain to other similar events?
Yeah, absolutely. It's the first of many. And like I said, there's going to be lawsuits, whether it be limited partners upset at their sponsor. And it doesn't even have to be, like you said, nefarious or fraud or illegal Ponzi scheme. It's just when people lose money, they get upset. So let me actually paint this picture a bit better because Freddie Mac, we don't know. I don't know what's going on, but Freddie Mac wouldn't do this unless they're being injured in some way. So they must have found problems that they are directly linking to Meridian to now go and say, yeah, we're blocking you from new business. We're talking about billions of dollars of business that Meridian does with Freddie. So something has to come up where Freddie is now in trouble. They're losing money. They're unhappy because like you said, when the market's hot, everything's fine. So Meridian pushed the envelope, but the deal's fine and Freddie's fine and everything's happy. Everyone's cash flowing, everyone's making money. So Freddie has to be hurt in some way to now retaliate. Same goes for LPs. If LPs start getting capital calls or they start losing money because the sponsor is selling the property at a loss, lawsuits are going to come out and things that were swept under the rug before are going to come to light. But in a good market, those things would have been fine. The limited partners would be okay with it. So it is a manifestation of a down market. And so this is going to be an interesting time for us to be a part of the market and to learn and take advantage.
Speaking of other problems, there was a article with Arbor as well that I want you to unpack and I think is important to unpack. So we've done business with Arbor before. They have good people at Arbor, but what the heck is going on there? Because it does not sound good.
Yeah, so I don't know if you read that analysis, and that analysis was biased. It had typos. It wasn't that well written.
So it could have been written from me.
uh, well, it was maybe slightly above your pay grade, but still, maybe you had a hand in it. I don't know. It was a good analysis. It just kind of surprised me with some of the typos and bad wording, but it was basically an analysis talking about Arbor and their balance sheet and saying that Arbor made a lot of bad loans. But hey, guess what? Every bridge lender did that as well. So singling Arbor out, I don't think is fair or necessary because I think, but what is interesting about that analysis is I think it's largely accurate. However, it's not
not
unique.
exclusive to them. Yeah, it's not exclusive to them, right?
Exactly. It's just
they just got picked on.
Right. It's a nice representation of honestly what a lot of people in the market, and when I say people, I mean specifically bridge lenders, CLO lenders, are dealing with on their book. I mean, the reality is if you made loans, back when rates were 3% on deals that were projecting to have a stabilized yield on cost of 5.5%, and today rates on your bridge product is 9.5%, you're underwater. You're losing money. You're if you have $100 million bridge loan book, that portfolio is worth, I don't know, 80 cents, maybe, if you made a lot of risky, aggressive loans. So, let me clarify. I said $100 million and then I said 80 cents. So what I mean is $100 million is what you lent out. That portfolio is maybe worth 80 million. So you're, as a lender, taking a $20 million loss. And let's not forget about the equity in those deals. That implies that the equity is worthless. So if you're talking about borrowers and equity, forget it. They've lost their money.
Yeah. So the equity basically dissolves. And it's kind of a fascinating conversation to think about, which is for lenders, there's just such limited upside, right? There's either, hey, the deal goes well and you make whatever the interest rate is, you make some origination fees, maybe some, prepayment fees to get out of the deal, but there's not much juice there. And there's frankly a ton of downside associated with debt, right? Like you can lose everything on the debt, you can get the property back, which the lenders really don't want to do. And then you only get a couple of points on the front and back end. So can you kind of walk through that maybe a bit? Just the lack of, I guess, a true upside in there as opposed to what we get to do?
Yeah, that's exactly right. Debt has a fixed upside and unlimited downside. Well, I mean, I guess technically not unlimited, but you can lose everything and you can only make this much. So that's why when people are in the credit business, it really, you can appreciate and understand where they're coming from when they're very conservative, right? You can get why a lender or a bank is kind of pessimistic. That's what they're paid to do. They should be pessimistic. And equity has unlimited upside and a limited downside. So they should be optimistic. So, it's funny, I wouldn't want to hire an acquisitions person who's pessimistic. That doesn't make sense.
We've had that before.
So, and then similarly, if we were managing a debt strategy, I would want to hire someone that's pessimistic, that's a deal killer, because that's the nature of the debt business. So, but what happens in heady times and what happened with bridge lenders is they were all competing in a race to the bottom with rates going lower and lower. They were out trying to win business and they were originating bridge loans at extremely low rates and tight spreads. And it's just a crazy time.
Watch talk. We haven't talked about watches for a while on the show. You had something you wanted to bring up though.
I
Do you
do.
want to share with everyone your most recent thoughts?
Yeah. So it's actually interesting because, as some people on the show might know, my uncle is a watch dealer with 40 years experience in the business, 25 years specializing in Patek Philippe. And the watch market's crazy. The watch market is way down right now. It's like the stock market. Well, not really, because the stock market's up, but it's certainly like real estate. Real estate is down. Watch market is way down. And my uncle's been through many cycles, right? Being in the watch business for 40 years. So it's kind of similar to real estate where he's seen these cycles. So he knows what a downturn looks like, feels like, and he's made money through the downturns and he's ridden up the highs. And so right now he's telling all his clients to not sell. Do whatever you can to not sell your watches. So because why? Why would you sell while the market's going down? And he's not necessarily advising everyone to go out and buy a ton of watches like crazy. He's still picking his bets and he's looking for unique pieces that are under the radar. So, like, for example, generally speaking, watches on a leather strap are not popular today. People want the steel sports watch, they want the bracelet, or they want the gold watch. So that's the hype. Yeah, exactly. That's a hype watch. That watch is worth a lot. It's a fantastic piece. One of the
Well, it's
best.
also it depends the price point on watches too, because this is a lot more palatable, which is it's not cheap. It's a lot more obtainable than what some of these really ultra rare pieces could be. So the price delta on this has a lot less swings than what some of these rare watches could theoretically have. Is that kind of what you're getting at too?
Well, that's so yes, because that's a steel sports watch from Rolex. That's an extremely liquid and in high demand piece. And so it's like a house in Atherton, right? How much can that go down? There's just too much demand and there's limited supply. And to your point, because it's only approximately a $20,000 watch, there's a lot of people in the world that can afford that. So that's why it's so liquid. Now, if that were a $2 million watch, right, there's only a handful of people that can afford it or want that. And so that's where you could see bigger price swings and more risk because of the illiquidity of that watch, right? Like your watch is more liquid than all the real estate we own, right? That's a very liquid asset. And liquidity isn't just how quickly you can convert an asset into cash. It's how it's how fast you can convert it to cash and how closely to its intrinsic value you can convert it to cash, right? Because if you need to fire sell something, you're going to take a fire sale discount. Well, you could fire sell that watch and still get pretty much its value. That is liquidity right there. So going back to the point, right? Like leather watches, like leather strap watches are less in favor. So my uncle's looking at under the radar pieces where he thinks he can buy a watch for 50K and then in 5 years time it'll be worth 150K, right? So that's kind of where his mind's at, but I like his advice, and we were having this conversation the other day about don't sell anything. And it's funny because I am selling some watches right now and it's just not a good time. I'm taking losses, but
That's market agnostic.
let me say that I am selling because a few reasons. One is I don't want the watches. And so I don't want to just hold them and have to hold them for 4 or 5 years to then sell at a higher price. I'm happy just to take the loss, get rid of them, and then repurpose that capital to maybe some of our upcoming real estate deals, which are going to be very attractive. And I'll be able to double my money over 5 years there. Or if I do want to buy a new watch, I can repurpose those funds to buy a new watch in this down market and essentially average dollar cost average, right?
Hey,
So
you're 1031 exchanging almost from, hey, it's so funny. If you're buying a house, if you're selling a house, if you're selling a house when market's hot, well, guess what? And if you need to buy one, you're also buying when the market's hot or vice versa. So as long as you're making that transaction and that trade within a compressed time period, you're getting it on both ends, right? Similarly, if you are exiting your watch here, some watches have bigger swings, but you could probably get into a great purchase price. And economically speaking, it's basically a fair trade. But, maybe you want to sell your watches and put it into real estate. Well, that's not a bad option either. So,
yeah, I mean, like you said, different watches have different pricing actions. So just like in stocks or real estate or watches, in a perfect world, if you had to sell, you would sell one of your watches that is taking less of a drawdown, right? So to use an example that's actually non-watch related, for example, we have a friend who owns a single family home. And in today's environment, it's actually very fascinating the way that single family home pricing and multifamily home pricing have decoupled. They've become divergent. So single family is still doing quite strong, whereas multifamily prices have come down a lot. That's the perfect opportunity to sell what is dear and buy what is cheap, right? You can go ahead and make an arbitrage play there, sell off your single family home and 1031 exchange it tax deferred into a multifamily investment opportunity. That to me gets me so excited. I think that's such a smart deal. Similarly, in the watch market, perhaps you have a watch in your portfolio that is really strong performing wise, and you could actually sell it and then buy watches that are way discounted and kind of cheaper, right? And so that way you're still averaging into the market, right? You're unfortunately selling when it's low, but you're also buying when it's low and hopefully buying lower. So, but the interesting conversation that my uncle and I were having was that right now, the only people that are selling watches are people that have to sell. It's the same exact thing as real estate. It's the same exact thing, right?
or seller. Yeah.
What are we hearing in the real estate market? This seller has to sell, right? Don't sell unless you have to. So we're seeing in real estate and in watches, the only people selling is because they have to, and that means they're willing to take the discount today. However, there's also another reason why people are selling watches, and that's actually kind of like me. So people who are selling watches right now, either they need the money and they have to sell, or they don't care about the money. It's funny. It's the two ends of the spectrum. Either they have to sell because they've fallen on hard times and they have to sell this watch to get the cash to go live or do something, right? Or they don't care about the loss and they don't care about the money. They just want to sell the watch and move on. So you have
they want to reposition and transition their wrists, right? They maybe don't serve a purpose in the wardrobe anymore. They're not wearing it, or they're trading it for something that is better equipped for what they want to be wearing currently, right? Which is kind of where you're at.
Yeah, it just basically, the two ends of the spectrum are people who really need the money or who don't need the money at all, right? Like I'm not surviving off the money I'm going to get, the cash I'm going to get from the watch sales.
I thought you finance your watches.
No. So it's an interesting situation, and it's true in real estate as well, right? There's people who are selling because they need the cash, because they need to pay off their lender and they're distressed and they're forced sellers. And then there's the other end of the spectrum, which we actually bid on a deal last week where the people that own the property were three different couples in their 70s, and they don't care. They don't care that they're selling in a worse market where, 2 years ago they could have gotten a super big number and now they're selling at a lower number. They're in their 70s. This is just a little asset. They are getting rid of it. No big deal. They don't care about the money, right? So it's those two spectrums right now that are selling in the market. So I found that very interesting to link it to the real estate market. And it's the exact same thing in the watch market.
Very cool. Anything you have your eyes on in the watch world right now?
Not really, honestly.
This is the quietest you've been in a minute in this subject. You're not even like, itching or like striving for everything. It feels as if you've kind of got what you want right now. And it seems that you might be on a sabbatical after you kind of uh, unload some of your current inventory. Maybe you could shore up your final piece or something else there at your birthday. But after that, I don't really see you making any acquisitions unless, an 80 gets you like a Panda or something that's like a how could you not from a purchase price perspective, right?
Yeah, sports Rolex would always be welcomed into the portfolio at the right price. But yeah, there's nothing burning. I do really, really love the rose gold Nautilus, as you know, I talk about all the time. But my uncle is begging me not to buy essentially a gold bracelet watch. A watch like this that's gold but leather is fine, but a gold bracelet he just thinks is not good in today's climate. There's watch theft is on the rise. It's also, he thinks it is distasteful. If you walk into an old money crowd and you're wearing this gold watch, it's a bit much. It's flashy, and so he's really pushing me to be conservative and not go in that direction. But the heart wants what it wants, and the heart wants a gold Patek. So,
well, if you buy that, you'll probably do pretty well on it. And to that point, the yellow gold 40 millimeter, even day date, I want to get to 36. I have small wrists, but the 40 millimeter day date on the aftermarket right now, I'm seeing it trade between 35 to 40K. And at the market high, it was like 60, which is nuts.
I mean, you're talking about the rose gold anniversary piece trading up to 100 plus. It's absurd.
That's what happens when the crypto market. That's what happens when all the Bitcoin bros and the NFT folk get wiped out. They can't trade that legitimately the most fake asset into a hard asset, right?
So yeah, no, that the crypto market absolutely fuels the watch market, because and I say this kindly, when the crypto nerds get a pump and they make a lot of money, they sell off the crypto and they buy a hard asset, which is watches.
And it's funny. It goes further than that. What your uncle is referring to with that Nautilus being rose gold is very much so a new money piece, is kind of what he's getting at.
Exactly.
And
it's a new money piece.
Nothing is giving new money more. Nothing screams new money from Mountaintop than everyone in that kind of sector who, wants to be flashy or tends to be flashy. And listen, we get it. Sometimes I appreciate the flash. Being in the Bay Area, there was no sizzle. There was just steak. But it's funny. You go to Southern California or Miami, it's all sizzle, zero steak. So I can appreciate someone who's got a little bit of swagger to them and, wants to, get a little bit more swagged out, if you will, than the people who drive Priuses wearing Patagonia vests in the Bay Area who make, millions of dollars a year. So it's kind of funny that the more flashy pieces are kind of not doing so well, and the more basic, reasonable pieces, the sub $30,000 pieces, are still holding pretty true.
Well, yeah, and it's because of the crypto boom and everything. The flashy pieces are the ones that went up in price the most, and now you're seeing them come down the hardest, right? Because what comes up comes down, and so that we saw that price action happen. It's kind of like in real estate with Phoenix. Phoenix was the best market in the country. People were just breaking their necks, dying over buying Phoenix multifamily. And that market was just appreciating like wild. And what comes up must come down. And now we're seeing prices come down the most in Phoenix, arguably,
Phoenix is
than
a weird
other
market
markets.
though. Phoenix, if you look at it linearly from 2008 to now, it would look normal, like to normal market average appreciation. But Phoenix got zero appreciation and did not rebound well at all from the great financial crisis, from the GFC, as you call it. So very interesting. It was really slow. The market here is a lot more boutique. It's a lot more robust here than it was before to that point, but it is nuts to see the shift and some of the distress coming up in the Phoenix market. So to our friends who own and operate in Phoenix and have bought in 2020 and 2021, I wish you well in your endeavors coming up as to how you position your property on the exits and maturities here coming up in the next couple of years, because it does not look very good.
Yeah, short term doesn't look good, but Phoenix is still such a strong market and
We
benefits
might we might
from.
buy in Phoenix at some point.
I would love to. Yeah, it benefits from low property taxes, low insurance, so it has a great expense side of the P&L. Revenue side, historically, well, maybe not historically, but the last 5-7 years was fantastic as well. I think the revenue side's really going to struggle coming up because of all the new supply. So I think rent growth is going to be muted there, but the expense side will still be fine. So yeah, it's still a great market, and I think it'll rebound better this time around out of the recession than it did out of the GFC. I just think it's a different market now. So yeah, a couple other things on the watches, just to kind of round out. I mean, I'll be on the lookout for unique pieces, for good buys. You know, there's buys that you do with your brain, and then there's buys that you do with your heart, right? So I would buy the rose gold Nautilus with my heart, but I would buy potentially something else with my brain, right? If my uncle says, "Hey, this watch is for sure going to double in value. It's super rare. Here are the characteristics of it." I might do something like that as well. I mean, by and large, I own watches to enjoy them. It's a passion and a hobby, not a financial endeavor. But when you're talking about such big sums of money, it has to be a financial endeavor. You have to think about it with the financial element in mind. Otherwise, you're just playing with money. So that's kind of where I'm at. And also, uh, what I'll tell you, maybe I should have told you this before we're airing, and I'll keep the name private until he's comfortable revealing his identity, but it's not a done deal because no money's changed hands, but I have sold my Aquanaut to a friend, and I'm not going to tell you who until we stop
I
recording.
already know who it is because you very much so tipped it, and hopefully he's listening to the show still because I know he and his other friend were. So I love that trade. It's good people doing good things together, and he just acquired a beautiful other day date as well. So
Yes, he did.
he's got quite the arsenal.
Yeah, I mean, it's
Would your uncle like his gold AP?
sure. I mean, it's like you said, new
I don't think
money.
it's his taste. I don't think it's his
Yeah, no,
taste.
no, no.
Yeah, it's not. You're
No,
being
but
nice.
we don't want to out his
But
portfolio. We want to keep his
yes.
portfolio private, but perhaps we can talk more in depth another time about it. But yeah, so it's cool to find a buyer that is actually a personal friend because he's getting a great number because right now is not a good time to sell. So I'm selling at a loss and I'm selling at a cheap number. He's getting a great deal. And hey, listen, if you're a friend and an investor, I'm not going to negotiate with you. I'm going to give you a great deal because that's just what it's all about. So
we don't negotiate with terrorists and we don't negotiate with friends when it comes to watches. Is that what I'm understanding?
correct.
Okay.
So we haven't really advertised our passion, or we haven't really discussed our passion for watches on the show in recent episodes, but we should just bring that back and just let everybody know that if you are a friend of ours or an investor of ours and you want to buy or sell a watch, please let us know. We'd love to make a deal work with you and get you the best price on a great piece.
And with that said, I think it's kind of funny. This is my final closing thought. Cloth Top is going to have to go for another
Yeah,
show.
correct.
So we'll save the people that for another time. But I will say this. I don't understand why people buy watches to not wear them and just to look at them. This goes on me if I'm swimming laps. If it goes on me if I'm lifting weights, this doesn't leave my wrist. To go to bed, maybe it comes off. That's it. This will never leave my wrist. It might as well be surgically attached to me. So this thing is indestructible. Some people have these things and don't wear them. This thing's not getting scratched. Okay. So wear your watch. It's cool.
I agree. Don't be a safe queen. Enjoy your watches. I don't know. My uncle highly disagrees with this, but who knows? Maybe he knows
I
a
will
thing
say this:
about watches.
when I get when the market is spruced up and we're killing it, we're buying every single deal, and there's excess cash that I don't want to invest and want to enjoy. I will buy the 36 millimeter day date yellow with probably the white face, but maybe black face. Who knows? Maybe even green, and it might make you upset. But with that said, that will not be worn as much as this. That'll be my kind of, maybe once a week piece, maybe once every 2 weeks. Maybe I just walk around it in my house wearing it. I don't know, but this is the everyday piece. Get a steel everyday piece.
Yep,
And with that,
100%.
thank you for listening to episode 23 of the Capital Spotlight podcast. If you're looking to raise equity for any deals, you have my email, my final call to action, craig@lscre.com. Let me know if you're a fund manager, JV partner, retail investor, LP investor, know someone to know someone, like, comment, whatever you got to do. Keep watching the show. We thank you for your support. Have a great day.